Hello, I'm Thomas Taplin and welcome back to Dukascopy TV and to the weekly wrap-up. This is where I discuss with my guest the events of the last week and also look ahead to next week as well. Well, on the line from Wiltshire in the UK is Bill Hubard, Chief Economist at Markets.com, whose career in the finance industry and markets spans over 40 years. Bill, thanks very much for joining me today. Now, we've seen a host of announcements from the big central banks, including the RBA cutting its interest rates down to 25 base points to help boost the Aussie economy. Then came the ECB and BOE's rate decision to leave interest rates unchanged. And of course, we had the FOMC minutes for September. We've also seen a meeting today by the Bank of Japan, who left its rates unchanged as well. Now, can you talk us through these in a bit more detail and their importance as far as the global financial crisis is concerned?
Well, with the RBA, it was a simple question that the economy is really starting to sputter. And for people who don't follow, quote, commodities or stocks, we saw that because of the dramatic drop in iron ore. So what they're trying to do, that is having somewhat of a domestic effect on both retail sales and housing. So where the RBA had sort of felt that they were immune, basically had to come in and drop rates 25 basis points to, quote, get with the program. With the Bank of Japan, again, no change whatsoever. Looking at both the Bank of England and the ECB, well, the Bank of England did exactly what I was expecting, no change whatsoever. But remember, for both the Bank of England and the ECB, their next meeting in November is 48 hours after the U.S. presidential election. So if they wanted to, they could easily take, quote, the coward's way out this month by saying, we'll wait till November. With the ECB, basically what they did, which maybe frustrate some people, was, hey, we're going to turn this back to the government. And this is one of the things where the market felt positive about what the ECB did last month, was the simple fact is they overtook the government and said, we as a bank are going to do something. With the ECB, I am expecting, looking at the data as it is as of today, another 25 basis points either in November or December. And with the Bank of England, I am expecting another 50 basis point quantitative easing in November from the Bank of England. With the Bank of Japan, again, no change whatsoever. The Federal Reserve, we will watch and wait because really they will not do anything more than what they've just announced until after the U.S. presidential election because the Federal Reserve is anti or not political in any way, shape or form.
Now, another issue this week was the news that Fitch Ratings agency could cut the UK's treasured AAA credit rating. Do markets care about credit rating agencies anymore? Can they be used as serious indicators of a country's financial stability, for instance?
The simple fact is nobody really cares whatsoever. And I guess from my standpoint, I have a problem here in the UK because about 3 months ago, we had 10-year yields at the lowest rate since 1690. So my feeling is if I'd been the Chancellor of the Exchequer, I'd have issued so many bonds, we would have flooded the market. Now, the market doesn't really care whatsoever about but credit agencies, what they mean, et cetera, et cetera.
Bill, this week has also seen political tensions between China and Russia over oil, and most noticeably tensions are rising between Turkey and Syria over shelling that killed 5 on Thursday. What's your assessment of how these particular political issues are affecting oil, and in Turkey's case, its rising bond yields?
Well, what we saw, especially in oil, if you've seen oil price in the past 48 hours, we've had a 9% move, 4.5% down and then 4.5% up. So one thing we saw earlier was the simple fact is with the rising tensions in the Middle East, okay, April, spring, even going back a year ago, okay, we had actually a reduction in oil prices 3 days ago. The reason why we saw the squeeze in oil prices yesterday because of a fire in Texas, okay, concerned about the possibility of oil being piped through. So oil has basically divorced itself from the political situation, whether it be China, whether it be Russia, whether it be Iran, whether it be Syria, Turkey, et cetera, et cetera, et cetera. And as I say, the only reason we saw the increase in the oil price was because of the fire at one of the Exxon refineries. And also with Turkey, it's a situation where this will be sort of an instant flight to quality, if you will. So, I don't see, any play like that because, one, we don't have any major clients in Turkey. We don't have people that really are following the Turkish bond market. But one of the things that you have seen is I'm more concerned about Spain's delay. And as we've seen just this week, okay, in the past month, we've seen the 2-year Spanish note back up 50 basis points. We had a mediocre to very poor bond auction as we wait for Spain to come back, whether it be this week, next month, etc. So the market is looking far more at what's happening with Spain in reference to bond yields. And as I say, I don't think people are even looking at Turkey. And as I say, the situation was we've had a dramatic sell-off in oil because of the slowing growth. And as I say, we only saw the squeeze in oil prices yesterday because of the fire, the Exxon refinery in the state of Texas.
Finally, looking ahead to next week then, Bill, and after today's NFP data, what will you be keeping an eye on?
But one of the things that we have to be looking at is in the Eurozone. You know, we've got the finance ministers meeting in Luxembourg, again, in preparation for the next EU summit. And this really reiterates what Super Mario said yesterday. The ECB and the banks are doing all we can. Now it's going back into the hands of the politicians, and this is what the market does not want, okay? And one of the things that we have to be looking at is the data next week, okay, will be a lot of the industrial production data. And again, it'll be the question of how quick or how deep the recession will be. But the market, as I say, really, after today's non-farm payrolls, the market will be focused on what the finance ministers, what the government say, and what is or isn't happening with Spain. So unfortunately, we have no major data next week, but it will be socio-political rather than economics, which will move the market next week.
Okay, thanks very much for joining me, Bill, and for your analysis on what's been happening this week. Today, of course, is the last day of the trading week, but I'll be back on Monday with a review of the day's financial news. Until then, have a great weekend. Goodbye.